What we are seeing is, since November, the United States has become a net importer of gold. North of 60 million ounces that we know of have been delivered into the COMEX. Gold is the only other tier one reserve asset in the world, according to central banks, and that was reclassified by the Bank of International Settlements. It's U.S. treasuries, and that's where it's been since the end of World War II, and since 2019, now gold. Now, let's just sidestep the fact that that could have been an error. Maybe it was, maybe it wasn't. We've seen tremendous deliveries into COMEX, more so than we've ever seen, and we've seen most of it coming from the LBMA in London, where they are a T+1 settlement exchange, where if you stand for delivery on your trade, it's T+1 is a settlement. On the third day, the metal should be moving. So much has come out of the LBMA. I think they've spooked the LBMA because of their rehypothecated position. I'll explain that in a moment. They've now all of a sudden gone to T+8 weeks. And they say it's a shortage of trucks and manpower. So the Bank of England evidently is short on trucks and can't make the delivery demands that are set upon them. To give you an idea, they have somewhere in the neighborhood of a float of 36 million ounces of gold, but yet that's standing behind somewhere in the neighborhood of 280 or 300 million ounces in open spot contracts. In other words, if every one of those contracts stood for delivery, over 300 million ounces roughly, there's only 36 million ounces for delivery. That's a problem. And on silver, the LBMA will be 260 million ounces in that neighborhood of silver that is unencumbered, right? They have 780, 760 total on the LBMA in their vaults, of which over 500 belongs to the ETF. So about 260 million ounces are supposedly available in London, but they trade 2.9 billion ounces per day, 3.5 times annual global mine supply. Again, if everyone stands for delivery, we got a big problem. And so all of a sudden they've gone from T+1 to T+8 weeks, which is a big issue because they say it's just a shortage of trucks. Imagine you have a multinational jewelry business and you own these contracts so that you can fabricate your jewelry. Sorry guys, we apologize. I know you're expecting your metal, but it's 8 weeks because we don't have enough trucks. This is almost the form of a default. Most of that metal is coming into the United States. As I've mentioned, we've become a net importer of the only other tier one reserve asset next to U.S. treasuries, which the world seems to be shedding. The are selling treasuries and buying gold, which has doubled the performance of the 10-year treasury since the turn of the century, doubled it with no counterparty risk. In other words, it can't be sanctioned, can't be taken from you. And what I find really interesting above all else is the tweet that Trump came out with on April 20th at 3:09 p.m. on Truth Social. He says, golden rule of negotiating and success, he who has the gold makes the rules. Thank you. Interesting. U.S. become a net importer. JP Morgan delivered $4 billion of gold at the end of February into COMEX for a customer. Who's that customer? Could it be the Treasury? Could it be the Fed? Could it be Warren Buffett? We saw the largest deliveries into the COMEX in its history over the last several months. And so as gold is coming in, which is the only other tier one reserve asset.
You know, it's funny. You talk to the average investor today and they'll tell you gold's boring. It's just sitting there, they say. It's not doing anything. But you look under the hood, and the story is so radically different, it's hard not to shake your head. Because since last November, we've seen a sea change, a complete reversal of a decades-long pattern. For the first time in my entire career, the United States has become a net importer of gold. Let that sink in. This is the only other Tier 1 reserve asset in the world alongside U.S. treasuries. And suddenly, it's flowing into the country like we're planning something big. Over 60 million ounces of gold, that we know of, have been delivered into the COMEX. And you don't need to be a seasoned trader to realize this isn't normal. These aren't your average hedge fund deliveries. This isn't retail buying Krugerrands or Maple Leafs. This is something bigger, institutional, structural, and frankly quiet. It's happening in the shadows while the financial media is busy talking about the next CPI print or whatever drama is playing out in the crypto space this week. Now, if you want to trace where this gold is coming from, just follow the delivery records. Most of it is exiting the London Bullion Market Association, the LBMA. That's supposed to be the gold capital of the world, right? T+1 settlement. If you stand for delivery on your trade, you're supposed to get your metal on the third day. But guess what? That's not happening anymore. Suddenly, and I do mean suddenly, they've gone from T+1 to T+8 weeks. 8 weeks. And the excuse? A shortage of trucks and manpower. Really? The Bank of England, that storied pillar of financial stability, is short on transportation? Let me translate what that really means. They don't have the metal, or if they do, it's already been promised to someone else 10 times over. Welcome to the world of rehypothecation, where 1 ounce of gold can be claimed by 5 or 10 different entities, all on paper. It works just fine, until someone stands for delivery. Then the whole thing begins to crack. And let's be clear, we're not talking about some marginal imbalance here. We're talking about a float of 36 million ounces of gold in London, standing behind somewhere around 280 to 300 million ounces of open spot contracts. If everyone asked for delivery at once, it would be game over. On the silver side, it's even more egregious. Out of roughly 760 million ounces in the LBMA vaults, over 500 million belong to ETFs. That leaves about 260 million supposedly unencumbered. And yet they're trading 2.9 billion ounces of paper silver a day, 3.5 times the annual global mine supply. Think about how completely detached from reality that is. And yet people ask me, why isn't silver moving? This is why. Because the price is a fiction set by the derivatives market and manipulated by those who benefit from keeping real money suppressed. But when that leverage chain breaks, the snapback will be unlike anything most investors are prepared for. Now, let's talk about where all this gold is going. As I said, it's coming here to the United States. That should set off alarms in your mind, because the US hasn't been a net importer of gold since, well, it's hard to even find a time where that was the case, certainly not on this scale. And remember, this is happening while US treasuries are being sold off. That's the critical context. One Tier 1 reserve asset is being shed, the other is being accumulated. It doesn't take a genius to figure out where this is going. And then you get Trump posting on Truth Social, April 20th, 3:09 p.m. And I quote, "Golden rule of negotiating and success. He who has the gold makes the rules." He said that. It's not a meme. That's a former president, potentially the next president, giving you a playbook in plain sight. And this is happening while JP Morgan delivers $4 billion worth of gold into COMEX in February for a customer. Who's the customer? Nobody's saying. Could it be the Treasury? Could it be the Fed? Could it be a private party like Warren Buffett again? Doesn't really matter. What matters is the delivery, the size, the timing, and the silence around it. We've now had the largest deliveries into the COMEX in its history. That's not my opinion. That's a fact based on publicly available data. We've never seen anything like this. And at the same time, you have these signals from high places that gold is being revalued, reintegrated, however you want to frame it, back into the monetary system. Quietly, slowly, almost covertly. You look at the US balance sheet and you see something called the gold revaluation account. It's still sitting at $42.22 an ounce. That's the price it's been marked at since the early 1970s. You think that's going to stay there forever? Come on. Nixon closed the gold window in '71. The next year, he revalued it from $35 to $38. Then in '73, again to $42.22. That was a 40% devaluation of the dollar in 2 years. Gold wasn't going up, the dollar was going down. Same thing in 1933. Roosevelt confiscated gold at $20.67 an ounce, then turned around and revalued it at $35. That's a 70% markup in gold. Why? Because he needed to devalue the dollar to support Treasury issuance. Sound familiar?
You have all sorts of noise around the periphery, whether it be gold is held on every central bank balance sheet, including the United States, in something called the gold revaluation account. You can't make that up. Nixon closed the gold window in '71. He revalued gold. It was at $35. He revalued gold the next year, $72 to $38, which means he devalued the dollar. And then the following year, '73, revalued it to $42.22, where it stayed on the balance sheet ever since. In '33, over my shoulder, when Roosevelt confiscated gold, it was at $20 an ounce. He paid everyone $20.67. Well, if eggs are a nickel for a dozen back then, 67 cents is good. And then he devalued the dollar immediately by 40%, in essence, revaluing gold at $35 an ounce, where it stayed until Nixon closed the gold window in '71. Gold is the only other Tier 1 reserve asset next to what? U.S. treasuries, which everyone is selling. So how do you inspire confidence? Well, you issue treasuries backed by gold. Give it another year and 3 months before you issue them. Keep letting gold rise little by little by little, which isn't getting noticed by anybody except guys like you and me. And then maybe we'll revalue it market to market at some point or even higher and peg it to a new system where treasuries are redeemable in gold. Now, there's a lot of fact in what I just said, a little bit of supposition, but what I will tell you is that deliveries into COMEX are real. Whatever they want to tell us about that being a glitch or an error, may be true, maybe not. Maybe they just panicked and told everyone, we got to cash settle you for now. This is a problem. I don't know what they did. And maybe it really was a glitch. But the fact that the United States, first time in my career, has become a net importer of gold, the only other tier one asset in the world, all this gold is flowing in, and you have all of these entities at high levels talking about revaluation, pegging it to a treasury system, redeeming it that way. All of these things are coming together at the same time. And here we have gold at almost $3,500 an ounce, and there's not a damn person in the mainstream who's talking about it. Gold is not reacting to something. It is being quietly reintegrated into the fabric of the new monetary system. That's my belief, and that's why it hasn't caught the attention of the mainstream yet.
So let's take a step back and ask the one question nobody in the mainstream media is willing to ask. Why is the United States suddenly becoming the largest importer of gold the world has ever seen? Why is there radio silence on this historic event, even as record volumes of gold are flowing into COMEX vaults, and the LBMA is scrambling to delay delivery by a whopping 8 weeks? The answer, I believe, is simple. The game is changing, quietly behind the curtain, and those who see it for what it is are doing everything they can to position themselves for what comes next. This is not an accident. It's not about truck shortages. It's not a logistical blunder. It's a transformation. Gold isn't reacting to the news. Gold is the news. It is, in my opinion, being reintegrated into the very heart of the new global financial architecture. And the data doesn't lie. We're watching the physical market assert its dominance over the synthetic paper system. COMEX is being drained. LBMA is being cornered. And all the while, the Western media's role seems to be to lull the public back to sleep, to make sure they don't ask too many questions. But when Trump goes on Truth Social and says, "He who has the gold makes the rules," that's not a coincidence. That's a signal. And he knows it. They all do. You've got revaluation accounts, gold-backed treasury discussions, central banks repatriating reserves, and a deafening silence in financial journalism. Why is JP Morgan delivering billions of dollars worth of gold into COMEX? What kind of client places that kind of order? This isn't retail demand. This isn't an institutional hedge. This is either sovereign or quasi-sovereign scale activity. And when you consider that US treasuries are being sold off globally, while gold is doubling the performance of those treasuries since 2000, again with zero counterparty risk, you start to understand that there's only one direction the real smart money is heading. You see, you don't need to be a financial genius to connect the dots. You just need to have the courage to look at them. The Bank of England is backpedaling. The bullion banks are trying to quietly restructure their books. The ETFs are hemorrhaging gold, and yet prices are climbing. You have to ask yourself, who's buying all that gold on the other end? Where is it going? Because it's not sitting in vaults anymore. It's moving. And this movement, this global remapping of reserves, is not a temporary glitch. It's the groundwork for a reset. Not the kind you see on conspiracy blogs, but a very real, very systemic change in how the world assigns value and trust. When treasuries lose their global prestige, and they are, you have to replace them with something. That something has always been and always will be gold. Tier 1. No counterparty. No promise needed. Just truth in metallic form. But here's the irony. While central banks accumulate gold at record paces, the average retail investor is being fed ETFs, tech stocks, and meme coins. Meanwhile, premiums on physical gold are rising, delays in delivery are stretching, and refiners can't keep up with demand. This divergence between paper markets and physical markets has never been more extreme. And that, my friends, is where the opportunity lies. People often ask me, "Andy, when do you think this shift will be obvious to everyone?" My answer is always the same. It won't. It will be obvious only in hindsight, when gold is $5,000, when silver's north of $100, and when your currency buys half of what it did last year. This is the stealth move, the quiet before the revaluation storm. When they finally do reprice gold, whether it's to recollateralize the US balance sheet or to issue new treasury bonds that are partially redeemable in gold. They'll need it at market value, not at the outdated $42.22 on the books. So the higher the price drifts quietly upward, the more plausible it becomes that a future peg or partial convertibility will occur without needing to shock the world overnight. And this isn't just about gold, it's also about silver. The canary's canary, if you will. The last 5 years have seen deficits in silver supply, year after year. Industrial demand, solar panels, electric vehicles, military-grade electronics, it's all eating into supply at a time when mine production can't keep up. But here's the twist. Silver also happens to be a monetary metal. And when the monetary system sneezes, silver catches a rocket ride to the moon. The gold-to-silver ratio, for instance, has been screaming opportunity for years. If we just revert back to the 100-year average of 42 to 1, with gold at $3,300, silver should be at $78. If we go back to the natural ratio based on geological extraction, somewhere near 7 to 1, then you're looking at silver over $400 an ounce. Does that sound outlandish? Maybe. But then again, so did $3,000 gold at one point. What we're witnessing is what I call the accumulation phase. You're not late, you're actually early. And I say that knowing full well that the price has already risen considerably, but the public isn't in yet. Not in the miners, not in bullion, not even in the ETFs. The flows are still central bank heavy, and they're still being done with discretion. This is the smart money phase, the pre-revaluation stage. So if you're wondering what to do next, I'd say stop chasing trends and start anchoring in real value. The markets are shifting. Global trade is fragmenting. US hegemony is in question. And in times like these, you don't want to be holding empty promises. You want real assets in your possession outside the system. And that's exactly what gold and silver represent today. They are not investments in the traditional sense. They are insurance. They are time-tested wealth. They are the one constant in a world of shifting narratives. And if you ask me, we're standing on the edge of a monetary revelation that has been a century in the making. The real question now is, are you prepared? Are you going to wait until it's obvious? Or are you going to act while the crowd is still distracted by AI, crypto, and collapsing tech valuations? Because by the time everyone else is asking the right questions, the answers will already be priced in. That's the nature of these inflection points in history. They reward the prepared and punish the passive. And make no mistake, this isn't a drill. It's the real thing. The signs are everywhere if you choose to see them.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.